So my name is David Hernandez. I'm an associate director at Marquette Associates.
And I am Evan Frazier, senior research analyst also at Marquette.
And Evan and I are both excited to kick off this series of flash talks with the topic, what might de-dollarization and de-globalization mean for equity markets? The agenda for this topic is focused on three areas. First, we'll look at globalization and dollarization and what they've done over the last 50 years, talk about some of the causes and impacts that it's had. Second, we will look at more recent time periods and identify what we think are some interesting trends. And last, we will discuss how these trends might impact equity portfolios. So to get us warmed up, I thought it'd be cool to start with some definitions. And if you've read anything about globalization, you probably have come across several of these terms. So first, globalization, we'll define this as the increased integration and collaboration of people, countries, and companies throughout the world. So de-globalization, this is the opposite of that. It's less integration, less collaboration. Then you'll see some terms that are related to supply chains. Nearshoring is the movement or addition of supply chains nearer or closer to the local home market. Friendshoring is the movement or addition of supply chains to a friendly or allied market. Reshoring is movement of supply chains back to the home market. China Plus One is a diversification strategy that many companies are employing where they're keeping their Chinese operations but adding other operations in other parts of the world. And finally, de-dollarization. This is the movement away from the US dollar as being the key currency for global transactions. So in the agenda, I talked about that we would look at globalization and we would look at the last 50 years. Now, in order to do this, we need some type of metric. We need a unit of measure. And the metric we're going to use is global trade as a percentage of global GDP. And global trade has grown significantly since 1970. And if you hone in on a specific time period, 1986 to 2008, that 22-year time period saw global trade increase from 34% to 61%. Pretty dramatic increase. Now, there are several world events that pushed global trade higher. You had the end of the Cold War in the early 90s. North American Free Trade Agreement was enacted in 94. The World Trade Organization, that was established in 95. And China joined said organization in the year 2000. So these world events, along with several others, pushed global trade higher. Now, this data shows this through 2008. Later on in the presentation, we're going to revisit this data and see what it's done since then. But for now, I think it's important to note that globalization isn't just about trade. It isn't just about economics. There's also social and political components to globalization as well. And all three components, economic, social, political, have increased and increased dramatically in the 90s and 2000s. As an example, on the social front, you can think about things like migration, world travel, student exchange programs. On the political side, you can think about the dozens of treaties that were negotiated, peacekeeping missions, non-governmental organizational activities as well. So we've established that globalization has occurred. It's a thing. It's happened. But what types of impacts has it had?
Yeah, as far as impacts go, we can start with correlations across equity markets. And just to be clear, when we're talking about correlation, we're talking about the extent to which two variables are moving in tandem with one another. For example, a correlation of 1 implies that the two variables being measured are moving in lockstep with one another, whereas a correlation of -1 implies movement in opposite directions. This chart here shows a material increase in the rolling 5-year correlation between the S&P 500 index and MSCI EAFE index over the last several decades. You can see that figure. It hovered around 0.3 to 0.5 during the 70s and 80s. And then you can see a big old spike there in the 90s up to about 0.7 as globalization trends really started to take off. And it currently sits at about 0.9. And that's indicative of very strong positive association between US and non-US developed market equities. And although the emerging markets benchmark doesn't go back as long, you can see a similar story there as shown in the blue line. Now, you may be asking yourselves, why is this important? Well, one justification for non-US equity exposure in portfolios like yours is the space theoretically provides diversification benefits to investors that can allow for smoother patterns of performance at the portfolio level over longer periods of time. But recently, as you can see, those benefits have been minimal at best. And that's challenging. That's challenging for investors like us. And that's in large part due to the fact that markets are a lot more globally integrated now. So said another way, the supply chains and revenue streams for companies that are domiciled here in the United States can and often do look very similar to those domiciled elsewhere. And that causes similar performance profiles to emerge for US equities and non-US equities. So globalization also led to a rise in the prominence of the dollar as the world's global reserve currency. Now, when we're talking about a global reserve currency, we're talking about one that's held by global central banks and treasuries that can be used to conduct international transactions as well as to influence domestic exchange rates. The dollar has basically served as the global reserve currency since the end of World War II. And as it says here on the slide, a variety of factors led to the emergence of the dollar as the global reserve currency of the world, many of which kind of tie into this theme of globalization. So for instance, a rise in the importance of international trade, combined with the fact that the United States is an economic superpower, means that it's important for countries to hold the dollar in order to effectuate cross-border transactions. There are many benefits of having the world's reserve currency. One would be the ability of the United States to impose sanctions against foreign countries. Frank Kelly talked about this a little bit during his talk. That can include the freezing of reserves or the removal of foreign banks from the SWIFT platform. That can decrease a country's ability to conduct business across borders. Additionally, the world's demand for dollars allows the United States to both borrow and import goods at lower costs. And as you can see here, both US imports as measured by the trade balance, as well as FDI, foreign direct investment, have mainly ticked up since the 90s as globalization trends have proliferated. For those of you who aren't aware, Dave Hernandez is my manager at Marquette, so this won't be the first time I ask him about wage growth, but maybe specifically in the context of globalization, Dave, could you talk a little bit about wages?
Yes. Globalization has had an impact on wages for sure. And if you think about globalization, one of the things that it's allowed companies to outsource labor to the cheapest markets. And as a result of this, millions and millions of manufacturing jobs left the United States, particularly in the 90s and 2000s. Now, if we go back to 1995, when I was a 15-year-old whippersnapper, at that point in time, China's working age population totaled 830 million individuals. That was nearly double that of all of the G7 countries combined. Additionally, according to Oxford Economics, Chinese manufacturing workers were paid on average 40 cents per hour. This is about 2% of the average hourly rate achieved in G7 countries. So as a result of this shift in labor, China's share of world good exports grew from 4% in 2000 to 15% in 2020. Here in the United States, labor cost over that same time period, labor cost as a percentage of GDP fell from 65% to 60%. Here in the US, middle class and working class citizens experienced stagnating real wage growth during that time period, but they did have two key benefits. One was cheaper consumer goods, which means that they could buy more stuff, and the second was more access to credit, which means they could buy more stuff. Now, likely related to the manufacturing job losses in the United States, we've also seen union membership decline. If we go back to 1983, union membership as a percent of employed was 20%. In 2022, that number has been halved at 10%. Interestingly, if you look at the approval rating for unions in the United States, that's grown over the last 15 years, where the most recent approval rating is just over 70%. And we think this is indicative of the American public's general dissatisfaction with the wage and labor environment. And wages certainly have had a big influence on US corporate profits.
They certainly have. So perhaps unsurprisingly, as wages have come down, corporate profits, at least in this country, have gone up. So US after-tax corporate profits as a percentage of GDP represented by the green line and corresponding to the right axis on this chart, have more than doubled from the 90s through 2021. A lot of this is wages. A lot of it is just a function of globalization having allowed US companies to really diversify their customer exposures across geographic lines. And to that point, 40% of revenues for the S&P 500 index, which is obviously a domestic equity benchmark, is now derived from overseas. Globalization has also helped to keep inflation around the world relatively muted. Again, we're looking backward here. Much has been made, obviously, in the last 18 or so months about elevated price levels. But if you look at this chart and kind of slice it right down the middle, and you examine average inflation levels over each interval, two very different stories emerge. So from the 70s to call it the late 80s, global inflation ran at about 9% on average. But if you look at it from, call it the early 90s up to 2021, that number was basically sliced right in half. It ran at about 4.5% on average across the world. And this should make sense, right? Trade integration, reduced barriers to entry for market participants across the world. That effectively increased competition and imports, which led to the relocation of production to more cost-efficient countries. And all of these factors really helped to keep price levels down for the most part. So globalization may not have led to goods and services price inflation, but what it likely did contribute to is asset price inflation, specifically within equity markets. So from 1970 to 1989, the S&P 500 traded at about 12 times earnings, but from the early 90s up to 2021, that number was closer to 23, 24 times. And a lot of this is a function of the low interest rate regime through which we lived starting in the 90s and continuing until really the last year or two. And obviously when yields are low, investors typically pile in or allocate more towards stocks, which results in higher equity multiples like the ones we've seen in recent time. And when these rates were low, a lot of these low rates were due to those downward inflationary pressures we detailed on the previous slide, and a lot of that was due to increased globalization trends. So if the United States was the winner of this globalization game, China was perhaps the silver medalist. So as you can see in this chart, the Chinese economy expanded rapidly starting in the 80s and 90s and continuing into the century, growing at an average of 9% in each of the 80s, 90s, and 2000s. And even into the 2010s, you can still see an above average growth rate of just under 7%, which made China one of the largest growers in the world. And indeed, China really liberalized a lot of its policies, at least relative to where they had been, starting in the 70s and 80s, really opening itself up to foreign trade and investment. And since that time, it's obviously emerged as a key player on the world stage when it comes to trade with other countries. In fact, according to the Chinese government, so maybe we'll have to take this number with a bit of a grain of salt given what Frank Kelly said earlier, but China served as the largest trading partner for over 50 countries in the mid-2010s. And what's more, China did only $14 billion worth of merchandise exports in 1979, compared to over $2.5 trillion just a couple of years ago. So certainly very rapid economic growth for China in a relatively short period of time. So we've done our looking at the past. I think maybe before we look to the present and future, we can kind of summarize a few of the effects that globalization has had, not just on equity markets, but also the broader macroeconomic landscape. So first, interest rates and global inflation trended below long-term averages, again, starting in the 90s and continuing till really the last year or two. Additionally, correlations between non-US and US equity indices increased, as did corporate profits here in the United States, while wage expenses have come down. Additionally, China's economy grew rapidly, and that growth allowed that country to really emerge as a global superpower. And finally, the dollar really entrenched itself as the reserve currency of the world, thanks to continued strength of the United States. But that was then.
This is now. There's been several occurrences that has pushed us away from globalization. COVID-19 brought into question the resilience and reliability of supply chains throughout the world. You had Russia's invasion of the Ukraine, the Brexit vote back in 2016, the rivalry, the intensification of the rivalry between US and China, all of these things have led to less integration and less collaboration across the world. In addition to this, you've had several countries that have allied together, looking to decrease the dominance of the US dollar on the world stage. So with this turning of tide, with these recent trends, let's go back to our key metric on globalization, and let's get an update on global trade as a percentage of GDP. That number peaked in 2008 at 61% and has since fallen to 56% in the most recent reading of 2021. So with this trend of slowbalization, what other trends have we seen emerge the last 10 years?
Slowbalization is a pretty good term. I think we should have maybe added that to our commonly used term slide a few minutes ago. That's good, Dave. So yeah, we've also seen the dollar as a percentage of total global reserves decrease over the last couple of decades. So as the green bars here indicate, the dollar made up just over 70% of total global reserves at the beginning of this century, compared to less than 60% as of the end of the first quarter of this year. Additionally, other currencies like the euro, which can be seen in light blue, and the yuan in orange, have gained in prominence over this same time period. Now, there are a few reasons for this, and Frank Kelly alluded to some of them earlier, but for instance, when Russia invaded Ukraine, the US froze over $300 billion worth of Russia's foreign currency reserves, which forced Russia to switch to other currencies, including the yuan, which is now the most traded currency in Russia. So other countries are likely looking at that situation and wondering if disagreements with US foreign policy will lead to their assets being frozen. That's likely pushing some countries to utilize alternative currencies. There's also this belief, especially among countries in South America and parts of Asia, that diversifying reserve holdings into a more multi-currency type of portfolio can alleviate certain domestic macroeconomic pressures. So for instance, when the Fed started hiking rates early last year, many countries around the world were forced to follow suit in order to prevent significant capital outflows or depreciations of their own currencies. So again, there's increasingly this belief around the world that certain countries may not want to be so beholden to the macroeconomic fortunes of the United States. So that's a little bit on currency. Dave, maybe you could give us some tidbits on trade.
There's been some shifts in trade over the last 5 years. If we go across the ocean to Europe, the trade volume between the United Kingdom and the European Union is down since the Brexit vote of June 2016. In comparison, the trade volume within the European Union is up over 60%. So the EU is trading less with the UK and trading more with itself. Now, these trade dynamics and shifts aren't just happening overseas, they're also happening here in the United States. If we look at the imports from China, they have fallen from 14% to 11% between 2018 and 2022. In comparison, imports from Mexico, Vietnam, South Korea, and Taiwan are up 14% to 18%. This has actually created some interesting investment opportunities for emerging markets outside of China, especially the last couple of years. Now, to provide a real-life example of some of these shifts in supply chains, let's look at Apple's plans to increase the non-China manufacturing exposure. For example, the iPhone non-China capacity is expected to grow from 6% in 2022 to 25% in 2025, 3 years later. Now, where is this capacity going? Well, South and Southeast Asia are expected to be key beneficiaries. According to Bloomberg News, more than $7 billion worth of iPhones were manufactured out of India for the fiscal year ending March 2023. And other countries like Vietnam, Malaysia, Thailand, they're also expected to benefit. And other companies are following this path, this China plus one, this diversification of supply chain strategy, and that typically will mean less trade with China. Uncoincidentally, China's GDP growth has come down from the double-digit numbers that Evan spoke about earlier in the 90s and 2000s. The CME estimates that GDP growth will land around 3% on average for this decade. Now, there are many things that are influencing this number. You can talk about having a higher GDP base, which makes it harder to generate double-digit growth. There's been a shift in government policy leaning away from that pro-growth policies that were prevalent throughout the last couple of decades. There's been a slowdown in the property sector, but certainly global trade has had a major influence on these expectations. So with these shifts that we've been seeing, these trends, what does that all mean? Well, if we compare the first 20 years of this millennium and think about going forward, we think a strong case can be made for higher inflation, higher interest rates, higher wage expenses. We also think a strong case can be made for lower US corporate profits, lower correlations across global equities, and less of a dominance of the US dollar on the world stage, though the latter is likely going to take longer to unfold. So should this globalization trend continue, what does that mean for equity portfolios?
I'm glad you asked, because there are a few things that we can highlight here. So first, we think it's important to maintain a balanced exposures across US and non-US equities at the portfolio level. Obviously, the US has enjoyed a strong, really unprecedented period of outperformance over the last decade plus. That's led to inflated valuations for domestic stock indices relative to their non-US counterparts. Right now, the MSCI ACWI, which is a common representation of global equity markets, is about 60% US, 40% non-US. So we think having portfolio exposures that are somewhat along those lines is a prudent thing to do. Similarly, mega cap growth, as we all know, has dominated in recent times, so paring back excessive exposures to that space should serve investors well, at least from a risk control perspective, especially given the potential for higher for longer rates and the lower equity multiples that typically arise due to that type of an environment. Value stocks. We have been emphasizing this point for a long while now. They held up relatively well last year as we saw growth sell off. Should we see a sustained climate of higher rates, elevated inflation, more capex, et cetera, going forward, we may see positive relative performance from those types of stocks going forward. But at the very least, there's a diversification benefit that we can get there. And speaking of diversification, emerging markets. Should we see further deglobalization trends, we may also see that space exhibit a more uncorrelated pattern of performance relative to domestic stock indices. And then as far as absolute performance goes, it's obviously been a challenge space of late, but Dave mentioned there are pockets of the asset class that we feel like could benefit from increased deglobalization trends. So for example, EM countries in certain areas like Latin America, Mexico, for example, we've seen them materially increase exports to the US and other countries in recent time. Plus, a lot of those LATAM countries have either stopped hiking or actually reduced interest rates over the last couple quarters. All of these things are typically good, not just for economic growth, but also equity market performance. And finally, we'll just emphasize the fact that actively managed strategies can add value in certain areas of the equity market. And EM is actually a good example. So not only is it a relatively inefficient asset class, but China, which we've categorized as potentially being challenged in the near term, makes up over 30% of the MSCI Emerging Markets Index. So if we feel like China may further deteriorate due to increased deglobalization or other factors that are currently at play, it may not be a whole lot of use to just buy the index. Whereas if you hire an active manager, they can go where they see the most value and opportunity, either from a top-down or bottom-up perspective. So these are all things that we're thinking about as it relates to the question of potential further deglobalization and your equity portfolios. That concludes our talk. Next up, we have Haley McCollum and Brett Graffey to discuss private markets. Thank you so much for your time and attention.